say in the global fixed income market, you've been seeing for the past few years, it's been very much a market of the unwind of quantitative easing. And what you've got is fear in emerging markets now that you're starting to see rates rise in the US and rates rise a little bit slow in the EU. So what we're seeing is a pickup in global growth, which is quite good for emerging markets, but you're seeing a rising inflation, and there's a bit of fear that's being passed over to emerging markets. What you've seen in the corporate bond market is that spreads have been probably as tight as they've been historically, especially in the US, but yet you've seen a lot of issuance in those markets. So the market seems a bit complacent to the risks out there. And this, we feel, has given us the opportunity in your local fixed income markets or emerging fixed income markets. So the local fixed income market has been quite an interesting year to date. With the first quarter, you saw quite a lot of positive sentiment, emerging market positive inflows, and you saw the rand strengthen quite a bit, and the market is quite strong at the end of the first quarter. Second quarter has been quite the opposite, with foreign investors looking to exit emerging markets. And the main reason we feel behind that is there's quite a bit of uncertainty around your trade barriers, and we think there's a lot of uncertainty as to how strong the growth in the European Union will be. So this has been quite a drag on emerging markets in the second quarter, and you've seen rates rise across all our curves, our cash curves and our government bond curves. In the local space, however, if you think about where we were about a year ago, the political scene is quite different. We've got a different regime, and what we have as an inflation outlook is that inflation is still quite benign. We don't think food inflation is going to drive high inflation going forward. We think this market's not a consumer-driven market, and the consumer is quite tight at the moment. So the inflation outlook is quite benign. We think we'll probably be close to 5.5% over the near term, which is quite acceptable in terms of the SARB's inflation target. In our portfolios at the moment, we think we're being awarded some good margin of safety again, given the negative sentiment in the market in our bond curves. So we've been finding attractive opportunities again in our longer dated bonds, in your 20-year government bonds. We think that the real yield on offer is quite attractive. We were back close to 10% on your 20-year bond. Another area that we've been finding good opportunities to maximize the value on your cash, and mostly in your NCD space, we're locking in high real yields, I think close to 9% and 8% yields across your curve. So that's been a good opportunity. In our credit space, the credit space has been quite difficult for the year. There's been limited issuance and high demand, so you've seen credit space tighten. We're using this opportunity to sell into a bit of strength and free up some liquidity in the portfolios. One of the standout opportunities has been in bank bonds. We think spreads were quite wide, yet despite bank balance sheets being quite stronger over the last few years, and we've taken that opportunity. And then one of the standard opportunities again is we think that if you look back over the last few years, the All-B has been our performer, and we think our bonds will be a standout performer on a global basis again over the next year, with high real yields that you're seeing and an inflation outlook that's quite benign. One of the opportunities this year that we've added to our funds was in Eskom longer dated bonds. So for us, for the last few years, we haven't been able to tick sort of a management box, and you've seen quite big changes in the board of Eskom and in the management team of Eskom. We think Pakamani has a track record of turning around state-owned enterprises, and we think we've got a good opportunity there. From a margin of safety perspective, we think spreads are as wide as they've been historically, and we think we're being rewarded for that in government guaranteed papers.